Good morning, everyone. I am CA Shruti Gupta, moderator for today's Valuation Manthan session, Understanding of Value and Opportunity as SFA Valuer, organized by Valuation Standards Board of ICAI. We are delighted to welcome you all to an empowering journey through valuation expertise. Let's start today's session by welcoming the Honorable Chairman of the Board, CA Hansraj Chugh sir, for the opening remarks. CA Hansraj Chugh ji is Central Council member and Chairman of Valuation Standard Board. Sir, I welcome you for the opening remark.
Yeah, thank you, Shruti. I, on my own behalf and on behalf of the Valuation Standard Board, I welcome each and every participants from the nook and corner of the country and some beyond the country also, beyond the border of the country also. You see, like advantage of the technology has been great enough. This series with started with a thought कि it's not like physical कि we have to be gathered around 100 or so. It's limiting without any boundaries, maybe the hundreds or the thousands or maybe running into many more. With those kind of the strength, we gathered for the discussion on the different topics related with the valuation. Today we have a one of the our star speaker Rakesh Kumar Tulsian ji, who will be sharing with us understanding the value and the opportunity as a SFA valuer. You see, like the need of each and every topic, starting from the episode one or the series one. Today we are there on the 24th series. In the series, 24th number is on the row. So you see, like the journey has already been traveled, it has been established, and the every episode by episode numbers are increasing in the participants list also. Now it's more than 1,000 those who are the participants, and I get a full support from the office team, Dimple ji, Rahul, and the tech team also, and the team secretary, the secretariat of the our valuation standard board, Sonali Haldar too, with the bringing out so many good things in the whole of the ecosystem of the valuation standards board. The valuation standard boards, I'm really very happy to share with each one of you, is moving with the horizontally and vertically. We are growing with leaps and bounds. Very recently, we got a permission or the license from the IBBI also. Our RVO got a license from the IBBI to expand further the plant and machinery segment and the segment which relates with the land and building. Now we'll be looking forward for bringing out the standards on those front also. The members, those who are interested to participate as a somewhere as a resource person, though naturally land and building and plant and machinery is not a forte, it is a mainly related with the other professional friends, those who are from the engineering background or those who are from the architectural background or the background where need of those expertise are required. But anyway, if any of our participants is interested to participate and support to this valuation standard board, they can give an expression of interest. We have given a expression format there through the Google form on the website of the ICI of the Valuation Standard Board. You may visit them up, and naturally long matlab, that will be a contribution for the development of the profession. This board has a many vision which has been brought in front of you at a different point of time, and going forward, you see like the valuation professionals are bound to grow as the economy, as the front of the business is growing with. So with those parameters, we have to think about in the bigger perspective what we are today. That is not matters with what we will be in the future. That really bring us many values to be taken care of. So with this initial remarks, though I thought my our co-chairperson Preeti Savla may have been joined with, but maybe some other engagement with her. She has always been proactive in supporting this board, and she has always been a contributor and bringing out new ideas, new things to be taken care of by this board. These kind of programs has also been instrumental, and the brainchild of the our co-chairperson Preeti Savla. She hails from the Mumbai, from the western part of the western part of the country. She may join in between sometime. With this initial remarks, I welcome each and every participants. I welcome our speaker of the day, Rakesh Kumar Tulchandji, the moderator, Shruti, and the team at the our office also. I welcome each one of you, and at the end of the session, I'm very confident that every participant will be feeling more strengthened with the knowledge, more strengthened with the better understanding of the value and the opportunities available as a SFA valuer also. So thank you all. Thank you very much. Over to Shruti. Shruti, over to you now.
Thank you, sir. Thank you, sir, for inaugurating the session and directing us in the right direction. I will take a moment to make a small announcement here. I request all the participants to fill the feedback form. The link is available on your webcast screen. Your feedback motivates us to give you the best. Now I'm delighted to welcome our speaker, CA Rakesh Kumar Tulsianji. Thank you, sir, for gracing us with your presence. CA Rakesh Kumar Tulsian is an insolvency professional and registered valuer for securities and financial assets. He is practicing in the financial city of India, that is Mumbai. He is an experienced banker and renowned faculty in the area of insolvency, valuation, and information technology. He secured top rank and gold medal in BCom honors. He completed MCom from Sindhyam College. He passed CA Inter with 47th rank in India. He completed CA, CS, and MCom, all three examinations in the year 2003 and 2002 and 2003. During his tenure as banker, and thereafter he completed CAIIB, PISA, FAFD, Insolvency Professional, Registered Valuer. He has a vast experience as professional banker and has worked with IDBI Bank, DCB Bank, and has headed as financial controller Indian operation with State Bank of Mauritius. He is a faculty on advanced IT training, IBC, valuation topics, and has also co-authored books on liquidation under IBC. He believes in sharing knowledge and hence he regularly speaks on different topics. He is currently pursuing LLB and diploma in ADR. He is an expert in valuation, debt resolution, and advisory services. Words are less to describe his vast knowledge and experience. Thank you so much, sir, for gracing us with your presence. We are all eager to learn from you. Over to you, sir. Thank you.
Thank you, Shruti. Thank you, Chuk sir, for giving me an opportunity for presenting my thoughts on the valuations. And I always cherish to be a part of ICAI, being a chartered accountant and getting an opportunity to speak on various topics, including IBC, valuations, and technology. So I will not take much time and I will start on my presentation. But before presenting, I'm just showing my PPT. So basically, this session is all about discussing and knowing about the valuations. When we know about the valuation, see, there are three concepts. One is cost, one is price, one is value. So we are interchanging these three items on a regular basis. What are the differences, basic differences in price and valuation or value of the any item? We will see whenever when we proceed in the today session. Basically, what value is all about? It's a mixture of numbers and a story, both. When we say numbers, we as a chartered accountant mostly deals with the numbers. But valuation is not all about the numbers only. It is, 1 minute, I will just start my slide. So, yeah. So, the valuation get started with numbers or a story. If we ask this question, generally every story which is backed with the numbers is called valuation in real term. We require valuation in every field of our life, whether we have done CA. So what is the value of our CA course? If someone asks, what is the price we are paying for? So when we check what is the value, inherent value, we have to look at. And when we, as a chartered accountant, when we talk about the value, we always think about the stocks, shares, bonds, financial instruments, and all others. But value is always required when you look for any story, any big numbers. We have seen so many unicorns, so many companies which have sold uh, n number of their profit or turnover or whatever you perceive to they will share as a dividend in their future lifetime. So when we say value for a company means it's a story which they brings. Otherwise, if you've seen the Zomato, Nika, or any other unicorns or any other company, startup companies, they always talk about the valuations, that their n number of valuations have been increased to reach to some other level, where some companies who have not delivered even the profit or even not in justifying the value. People are always asking me, Rakesh, whether this company is valued that much. There are some concept called as a value investors also in the stock market. So what do you mean by value, and what do you mean by a startup valuation or any other valuations which we generally used to do, and why so much noise in the valuation field when we are talking about the bad debts or the banking stocks, when they give loans to any other companies. We have heard so many times for Adani is over leveraged and others. So how this value which you are doing as a registered value is come to play, we have to look at during the session of our today's session. So first thing is, uh, we will come we will start with one story of you take as a any company name you name. We will start with the Zomato or the Nika. This is all for our learning purpose. Nothing with the company's financials, and nothing as a we will say that we are taking valuation assignments on them. I am just discussing all the items as a for a learning for our benefit of our members. So when we talk about the success, which company is successful, which company is coming up, new technology giants or the new startups, how they value themselves and where they use the value when they go in the market and says, see, my company valuation is 1 million or 1 billion or something. We are a unicorn, and how? So how they differentiate? Sometime back, the Nika came and they become the first lady who have become a unicorn. Their company become a unicorn. So how it happens? What type of things which they bring it, which was not there, or the any company which is doing for last 10, 20 years or 50 years are not competing in terms of value of that company. So we are going to discuss all these items in later part of this today's session. So first thing is, so where we use the valuation. So as a chartered accountant, we used to do the valuation even before the valuation rules were made applicable. When the Companies Act 2013 talks about that some are the items which need to be get valued by the registered valuer only. So this registered valuer are the competent authority who determine the value for our companies. So value, if we say what type of valuations and where we use it. So at the time of new share issue or transfer of share or any buyback of shares, any merger activities, sale of our business or brand or unit, we need to get value of our business or the that unit. When we used to try to buy any business or sell any business, or whether we when we are doing a financial reporting in the India as fair value we have to do, and there are so many things where we use valuation in our real life. This is not a single slides where we can say that this valuation we use while purchasing any stocks or while doing our duty as a valuer. So who can become a valuer? As the valuation rule provides, any chartered accountant, company secretary who have an experience of more than 3 years can sit in the exams, get the proper practical experience of practical training for 50 hours, and then they get registered with the Insolvency and Bankruptcy Board of India, which is right now regulator for the valuer, and they came into the valuation field and they can do the company valuations. So where we change from as a chartered accountant, which we used to do valuation, and today registered valuer is one is qualification which has been prescribed by the IBBI, who are the regulator, and as well as in Companies Act or the SEBI Act, they have prescribed that the valuation should be done by the registered valuer. For income tax purpose, they are still insisting on valuation should be done by the merchant banker or the chartered accountant for a FEMA related matters. So these are the places where we used to work as far as opportunity is concerned. So now we will talk about the valuation more and talk about the value in particular in our session today. So value is nothing but a story. If any company who can sell their story backed with their numbers are called a truly valued company, and you get the n number and number of the turnover, revenue, or profit, whatever you say. And who does this valuation? Valuation is done by the registered valuer, but the informations or the data for that valuation is provided by the management. And if the management is have a very good story backed with the number, then the company valuation is much more higher than any other company which we are looking at. Now, when we are saying for a valuer, which company have a more value and what the preconceived notions the valuer have while doing the valuations. See, generally, as a chartered accountant or as a valuation professional, we used to uh, bog down with the numbers or the data which has been provided to us. And if you ask me, frankly, if some valuation assignment come to us, we will say, please provide us the financial statements of last 2 years, 3 years. Then we can say 5 years or 3 years, whatever data you have for future projections, you provide us, and then we get it cash flow, what type of cash flow the company is going to get in future, and future cash flow we are discounting it with the discounted rate, which is a rate for the cash flow, if and their purposes means whether we are doing valuation for the company or valuation for the equity holders. On that basis, what is the rate of return required by that company or the equity holders? We are discounting that cash flow with that, and then we come across for an n number of years which we have discounted, and we come out with some numbers. This is the number crunching business where we try to get the value, but this is not the valuation at all. If we ask me frankly, there are some companies which are not very good in number, very good in profit. They have not delivered a very good profit, but their valuations are skyrocketing and up to the roof. How it happens? There are some companies which have not started even generating revenues, but still their valuation is very high as compared to their revenue or the profit which they are producing right now. So how this all these things are taking into care? If we come out with some startups, when we talk about the startups, uh, in the first initial years they generally do cash burnout. Now there are some terms which we are using it, and if you are not familiar with, I will just make it simple for you. uh, cash burnout is basically a cash outflow which a startup do while they are young or when they are in a startup starting up cycle. Any like any life cycle of a human being, they are in a corporate also there is a life cycle of birth, graduate growth, then mature, that declining, and then that. So they also have to go through all that life cycle which a company have to go through in their life. So there are some period where they are growing company, their growth, they start and they grow, and then there's some point of time they will get matured, and after that they will get declined, and after that sometime they can get unknown by the market. So when we talk about this company life cycle, and at different life cycle, different valuations are taken care. So now, why I should care about the valuation? I am in between. I will start with so many examples to get it clear what valuation is all about, what value is all about, and I have to run through my presentation also. So in between, I will start my presentation. But there should be some story. I always tell that to my professional colleague that valuation is not about the number crunching. Number crunching comes later part of valuation. First is story. What is your story which you are telling it today? Whether you believe on your story, first you have to believe on your story, then you have to sell the story to the market, and how market perceive your story backed with the number is basically valuation is done. Now, where the register value rules comes in between, they check the story and the different points where the data is backed with that story, and then they come out with the numbers that see this is the value of the company. So there they have to work along with the management. Now, not only management, you get the information about the company with the outsider also. So first, as soon as I get any valuation assignment, I generally gather the information not about only through the Google, or not from the financial statement or the financial future projections which is provided by the management. I also go with I discuss with their team members or the employees or the outsider or any other person who are not related to the business. An outsider is basically giving a more correct picture about that organization than insiders. So we get the information of that company, and then we find it out whether this is there is some stories of that company, and then we backed it with the numbers. We checked the authenticity and the fairness of that numbers, and whether the numbers is backed with the story. So then you will get a good valuation when you talk about. So this is a specialized area where we have seen that most of the time, if you see the banking loans, if it get fails, most of the time we say this is a valuation issues. Valuer has done something wrong, or some wrong valuations, or valuation was overvalued or underperformed. So all these things comes into play when the things goes wrong. But as a valuer, what our role is to give the fair value, which is again subjective. One valuer valuation may be differ to from the other valuer. And when I do the valuation, I stick by that numbers, what value I have given, and why I have given that value, why I have chosen that value. So valuation, three things you have to look at when you are looking at the numbers is: one is cash flow, what type of cash flow which is coming up in the upcoming years, growth years, and then how many years you are taking for consideration when while doing the valuations. That may be 1 year, 2 year, 5 year, maybe 50 years down the line, or maybe throughout the life of the company. So that at that time you also look at that. And then third thing which we see is a rate of return, or the hurdle rate at which we discount the cash flow to get the present value. Basically, valuation is present value of the expected future cash flows. As a chartered accountant, we cannot certify the future numbers, future financial numbers, but we have to look and we have to see what type of stories the company brings into. I will take one or two live company example also for better understanding. All my discussion over here is basically give you a flair of the valuation for your day-to-day life. So now, what is the practice? Basically, is that is a specialized knowledge without cannibalizing the existing practice, and because India needs more valuation professionals. Currently, valuations are based on the intrinsic value, or the book value, or the discounting cash flow method. So these are the methods. We should not bog down with the methods, numbers, and others. We have to first look at the stories. Now, I will give you an example of you take Yahoo. Once upon a time, that was a very good company. You take an example of a Nokia. Once upon a time, they were a market leader, but innovations, they have not done the innovations which is required by the market, and they have gone. Kodak, we have seen in the past, they were the market leader in the camera, but the change in the market, they have gone. They have not changed. But still, if you look for the phones, they are coming with the cameras, and what better camera one phone have? They are the fetching a good price in the market. Now, so we have to look at, while we do the valuations, that what type of stories they are selling. Like you take a Uber, Ola, they are the company which change the market in the ride sharing, or the way people are traveling from one place to another, or commuting from one place to another. In their valuations is something different than their price. And what is the difference between the valuation and price? Basically, price is what you paid for, and value what you got in return. So if, and when we say price, when we compare price with the value, they may be overvalued, they may be undervalued. There are some items which are overvalued, and there are some items which is undervalued, because the price and the value may be, or most of the time, are different. And we are always confused, or the normal people are confused, that this is the price is the true value of the item, but it is not. Valuation is totally different than a price. Price is between the two unrelated person exchanging for something. So if I buy a iPhone, or buy iPhone shares at you say $100, then this is the price which I'm exchanging with the intended seller of the stock. Whereas the value of that company may be, suppose, $90. So in that case, what happened? The value is $90. I am paying 100, means it's a overvalued stock which I have bought. So there is overvalued, undervalued also. If I buy it at 80, it is an undervalued stock. So undervalued, you invest at that time, and overvalued, you sell. That way you make a profit. But how to know about that? What should be the value? And everyone who buy or sell, they become themselves a valuer for that stock. So we will see all those things with the unicorns also, with the consumer focused also. So now, thanks. That's the interesting. So what valuation is all about? It is about the finding the true worth of an underlying liability or an asset, given its substance regarding of its forms. So now, what is the substance? What is the forms? And we are always fuss about valuations. Okay, how the valuation is very high in one company and another is going down. We have to look at the corporate cycle also. If the company is in a growth stage, then their valuation will be much more. So, like, if suppose Uber, if you take a Uber example, I'm just taking Uber example right now, because today morning I also used the Uber. If you have a car, even then you can use Uber for different type of issues which you find. You don't have a driver, or you don't have a parking at that place, you don't want to bother the other working. And this is a lifestyle. How, if you are in a big city in Mumbai, and on a Sunday, you can get a ride very easily. Even in at the time when the business model, their business model is when the business hours are there, when the so many passengers are there and the cars are less, there is a surge pricing. So how they arrive it, and what they get it, and what value you put for a company. So when the valuers are putting their company, they see what type of revenues they are generating, what type of revenue they can generate, and how much time, what is the scalability, how much they scale up their business. So they don't, when you know about the Uber, you will find it out, they don't own any cab. It is just a service which they provide. They matchmaking between the commuters as well as the car owners. So and they get a commission in between. So their business model is very simple. So when you tell about your stories while doing the valuation, that should be very simple. That should not be very complex, and telling to the investors that you have done, and using with so many complex numbers. You have to tell the story, and you have to stick with that story, and you have to back that story with the numbers. And if you have done that, your sell through, your company valuation will skyrocketing. So in the case of Uber, which we have discussed some time back, is basically they are in a metro cities or any cities you go. As soon as you download the app, you will find it out which how many taxis are near about you. You will come to know when the rides come for you. You who is your driver, where you will reach, how much time you it will get into, how much you have to pay, and it will get paid if it is linked with your account. No cash, nothing, and the driver will also get on a particular date or after a particular ride that whatever he have earned, and in between they makes a profit. So now when the valuation is done with that company, and the investors who have invested in that company find that okay, suppose the valuation is done by the valuer is 10 crores, and that how he came into that number is based on their potential of growth potential, their line of business, their scalability, and what type of growth they can look for that business in coming future. I will give you one example of, I'm giving the names of the companies for just a better understanding. If you talk about the Amazon is such type of business. Whenever they come into any business, any business, that is sure that the competitor or the parties or players who are already in the business will make loss, because they come in the business to disturb the market. They look for the top line turnovers. They are not looking at the profit at first. What their philosophy is, they will follow. The profit will follow later on. And that same story they are selling it for last so many years, 20, 30 years. The same story they are selling, and people are believing on that stories. That whenever they come in any business, retail business or any other business, they become market leader with their army. And which is the army they have is basically their loyal customers in the name of Amazon Prime. They have millions of people who are paying them on a monthly or yearly subscription, and from there they will sell so many things to them, because as we know, customer is a king, and the price at which they sell in some of the market where they've entered, they sell at 100 rupees where the cost is more than 100 rupees. So how the competitor will compete with them? They will be out. They will be dead. And once they get the market share, then the customer will pay. And that's why the theory is all about that that profit will follow. And that's why their market share and their price are being high. So when we try to get the true worth of the asset as a SFA valuer, we are uh, authorized for, or we are given license for valuation of securities and financial assets. There are three type of asset class which has been given for valuation by the IBBI. Is one is land and building, second is plant and machinery, and third is SFA, securities and financial assets. And as a financial doctor of a financial health, as a chartered accountant, we are the best to judge about the companies, their profit, their growth, their value, and all those things. But we make a mistake that we see price or value as a sin. We are not here to sell the stock of the promoters or companies. We are not assisting anyone to buy or sell their shares. We are providing a value. What is the fair value of that stock or the company? So it talks about the methodology also. So in method, what we say, we find it out intrinsic value. Intrinsic value means what the company already have. Like they have established a company for 4 years back, 5 years back. They have invested in the capital in as a asset, in fixed assets, current assets, or the human capital, or any other capital which they have invested in, and their value has been gone up or down. We get that value, and what is the true value is one, either they have invested as a whatever price they have invested in the company as a cost price method. They can look at that cost price method, as well as we can do a valuation based on the relative valuations, means market comparison. Generally, one questions I always get asked, if a stock market, if we take a market value as a method of valuation, so suppose I will just take an example, like Bombay Dyeing. Bombay Dyeing is trading at rupees 150. So market is a true value provider. So whether the Bombay Dyeing value of per share is 150, if we ask this question, what is your answer? I feel that is not the value, that is the price which you are ready to pay for buying that stock based on some stories which the numbers talk about, which may be undervalued, which may be overvalued. Valuation is done by yourself, and that's why you have invested. You have some, they have some stories which you are believing in, and that's why you are buying. And the valuations require special skills. But what skills you require? You should be very good in understanding the stories, understanding the numbers, and you believe on that stories. If you are valuing that stock or some companies, you stand by that. That on this parameter you have valued, and you believe that stories is true, or how much true it is, and then you have done through. So do I really need to understand valuation? I have a wonderful running regular traditional practice. Why should I move into the new area of valuation? So sometimes that I don't quite understand valuations. As I told, people are making n number of mistakes in understanding value and the difference and the price difference between the two. Is it relatively difficult? And that's why, because no same business is there. There are same stories you can't sell with the two companies. Believe me, the company number 1 or 2 are known in the market. They are making profits, but not others. So we will take other examples also. I am taking much examples to tell you about the value, what the value is all about, what flair we have to look at, and what type of stories our promoters are, or the shareholders, or the any other one management is giving you, or what the outsiders is looking about that company all about, and then you do the valuation. Don't just jump on the numbers which is given to you and start working on that, crunching that number, which we are very good at. So I always believe that valuation, when we do the understanding the valuation of that, it is not a regular every day you have to look at 10 valuations you have to do, 5 valuations you have to do. Even a single valuation if you do, it takes a lot of time to understand, lot of time to understand the stories of that company which you are going to tell, because that is your valuations which you are giving to the outside worlds. That, see, in my eyes, this is the value of the company, this is the value of the shares. Now I am talking two things at a time. If you see, one is valuation of a company, and second is valuation of the equity. People will say both are same. No, they are two different things. When we take a valuation for a business, we take a cash flow for the entire business. Operating cash flow we are talking about. So when we take an operating cash flow and when we do the discounting rate of return, so rate of return we take as a weighted average cost of capital. Weighted average means, as you understand, in the finance, there are only two sources of funding. One is either equity, one is either debt. So even sometimes I got questions. There are some mezzanine finances which are a debt or part of debt, but it's look like they are a equity. Like we say, preference share capital. What it is comes into whether it's a equity, whether it's a debt. Then we have to look at the basic intent behind that instrument. So, and then we have to bifurcate that instrument into the equity or debt, and which is the more costly. If you ask the channel accountants that equity or debt, so equity is always costlier than a debt. Debt being tax deductive, you will get a tax benefit on the debt, as well as there is a because and they are a capital gearing also, used for capital gearing also. If you have much more debt, then you may trap into a debt trap. So it should be balanced so that tomorrow they cannot lever up your operations. So debt and equity, what is the cost of both? We get it weighted average cost of capital. And when we do the entire cash flow of the business and discounting it with the weighted average cost of capital for n number of years, which may be 2 year, 3 year, 5 year, or maybe n number of years, and we add it up, and then we do the value, we get the value. That is a value of the business. If we remove from that the value of the debt, we will get a value of the equity. This is one of the way method for doing the valuation for the business, for the equity holders. Another way of valuation for equity holders is you take cash flow for the equity holders, which is after removing the interest of the debt, and then that cash flow we will discounting it through the rate of return required by the equity holders for n number of years, and we get the value for the equity holders. So whether both will be same? Yes, most of the time both of these same. So there are two methods basically for doing the valuation for the equity holders in a company. So now there are so many things which we as a chartered accountant we can do in the field of valuations, because we are the expert. Our education during the articleship period, during the CF inter or final syllabus, gives us a tremendous benefit for being a valuer. So because we understand the numbers, we understand the stories, we have worked day in day out with our clients who are we are seen for so many, know what type of story they are selling and whether they will stand by with that stories. So why we chartered accountants are not going to do in, or most of the chartered accountants are not in the valuation field, is one, they don't have a time because they are travel in managing their current practice, current workflow. And there are so many changes coming up and deadlines and additional responsibility. So they are forgot about doing valuations. But believe me, these are the things where we find it out the value. We will understand the business more. We study, we read, we know the valuations which is going into the market. I will share one more thing with you over here. I will try as much as I know in that very small period of time given to me, uh, because I can talk for an entire day on the valuation because that is my passion. Basically, when we do, I always tell as a chartered accountant, we need to value ourselves. They know, no, someone will come and pay us a price for 5 lakh rupees for an audit or something. We need to look at our value. What value addition we are giving to the client? What type of training, what type of services we are giving to them? What type of our role in nation building? If you take an example of India, India is now get valued. Why? The story which is being told to us by our PM, we believe on that stories, and it is also backed with the numbers. When the numbers speak for you, your stories, your valuation is going to be up, and that's why our value is increased in the eyes of other stakeholders. And the same way, we have to increase our value for our profession. That's look, our institute has given us so many things to us, and we stand over here, and our value is much more than any other profession. Now we will take it another things. So now do appreciate that unlike the regular CA practice, a valuation service driven practice has number one, no periodic deadlines. There is no deadlines. Business will come and you have to give the valuation, which may take 1 week also, 1 day also, or 1 month, or maybe many more months also. And why? Why it takes so much time for doing a valuation? You are not giving any XYZ number to the business or to the outside world. You are selling a story with the numbers. My work is done if you understand that thing, that valuation is all about the stories backed with the numbers. If you ask me, if we generally as a chartered accountant, we tend to use numbers more than stories. But in valuations, the story is sold first. If you have some stories like Zomato, you have taken Nika, we have taken the case studies. We have taken the case studies of Amazon. We have taken the stories of Yahoo. We have taken the stories of Uber. What many more? You take SpaceX, which is saying in future they will travel. The men will travel to the space, and their value is much higher. Where the work is not there on the ground, you don't never know that it is maybe possible in 1 year or maybe possible in 5 years or much more time. But there is some stories which is sold in the market, and that's why when you sell your stories, your valuation is much higher than what you think of. There are some of the companies where valuation is much higher than their entire profit in upcoming years. So now we in valuation also we heard about the word under unicorn and super unicorn. Now also there are people are also saying there are some super unicorns. So what the unicorn is all about? Unicorn means where the value of the company is more than 1 billion dollars. So that is, they are called uh, unicorns. There are so many unicorns in India also, and it is increasing. There are some decreasing in trend in the valuation also, because realistic valuations are not there earlier, which is now changed. Because in valuation, one thing is you have to flow with the market. What type of हवा जो चल रही है मार्केट में, उसके हिसाब से आपके बिजनेस की वैल्यूएशन बढ़ती है. एक समय था जब आई एम यूजिंग द इंग्लिश लैंग्वेज, आई ऑलवेज कन्वर्ट टू गेट कनेक्टेड विद द ऑडियंस. नाउ एक जमाना था जब विंड मिल के समय चल रहा था. एक जमाना था जब टेक स्टॉक्स काफी चल रहे थे. अभी ईवीज का मार्केट काफी अच्छा चल रहा है. सो दैट वे यू हैव टू फ्लो विद द मार्केट आल्सो. नाउ we as we saw that unicorn, as I told, there is a decacorn. Decacorn is basically a $10 billion companies, which is also known as a super unicorn, like a Dropbox, WeWork, and all others. And when we talk about the valuation, we compare it with the US market, because there are so many companies, startups, which is coming up in the Silicon Valley, and which took the market by a storm. So now, when we take an Indian case studies for evaluations. So now, as I told you, NICA for girls, for a woman. When they have started their company, it's basically a digital marketing strategy they have used for. They have so they started with the digital marketing stories, and they are in the business of makeup, or you can say e-commerce business of a cosmetic, uh, and they give so much huge discount on the products. They have more than 2,000, 4,000 products with the uh, around 2 lakhs, 3 lakhs there. 1 lakh, 2 lakh products are there. 200 around brands are there. Inventory they have kept it in 7, 8 places. Stores are so many places. You go in airports and others, you will get that stores also. So prominent places they have stores also. They got a first unicorn. They have got listed in the stock exchange. First lady who have come out with they have made unicorn in India. So how they have sold their stories? They have sold their stories as parents in the market, that now you can get the product, beauty product, or the wellness product in the market. So that's why their market, the share valuations are much higher as compared to any other companies which is still in the market in the makeup field, or you can say wellness field. Same way, if you look at the approaches which valuers are using it to value the company. One, as I told you, cost approach. One is, I told you, relative value. Relative value means market price value, and we have discussed that market price is nothing but a price, or the not the value. That is a uh, what is a price which we are paying. Intended buyer is paying to the intended seller. So I will give 2, 3 more example whatever the valuation is. You take an example of so many years we are using the Gmail, Google. So what Google is all about? The Google is technology platform, search engine, everything they are coming with the one umbrella, and their prices are going up, their shares are going up because they sell aspirations. So many things they are coming up with. There are so many products they are coming up with because of their army. The people are who are attached with the Google, Gmail. No one remember now Yahoo search other than one or two countries. You can say China or Japan or like this way. So, and when valuations, we are talking about most of the companies, wherever you find it out, the valuations are skyrocketing due to the perceptions. Basically, valuation is nothing but a perception in the outsider mind about your company, about you, about your stories, which is backed by the numbers. If you believe, if the outsider believe that your story is true, your valuation is much higher. There are some companies which were making a very huge profits, but their future is declining. They are under dead weight. What they do? What is best for them? To pay dividend to find it out which is a growth company, and the investor will be happy. There are three ways which we look at the valuation: is cost method, market value approach, and the cost value, market value, and future value of the of that what we say income approach. Income approach. So there we do the different type of methodology we apply, different number crunching we do, and then we find it out what is the exact value of the company. If we take any successful, we have taken so many examples. We will take one example of Joe Books. So where what they change done, which tally, which was used by so many chartered accountants, is not able to do. It's basically mobile accounting. Whatever data capture you can do it with the Zoho or the Zoho books. That is not possible in the tally. Whatever the systems, they try to get it done. So many things now you get the examples where you find that valuation of the company is much higher. Like you take an example of Jirodha, which is a successful company. There are so many share brokers who are doing in the business, but no one copied the Jirodha. There are startup companies. What is the meaning by a startup? Why we look at always we talk about the valuations and coin with the startups. So a startup basically is a company which is under growth stage, which is going to grow. New companies which are coming up, they grow like anything. They are working like youngsters who make mistakes, and that's why when we say about the startups, uh, not many startups are successful because they behave like college students. They don't they don't bother on the risk part. They take risk. They want to grow, and young company, they may pass, they may fail, but they come out with some ideas, which is, and they have some stories to tell. But whether and why they fail when they have a stories, because they are not stick to that stories. They don't believe themselves on that story. It seems some time of time. And how you fund? If we ask a question for startups, because they are growth companies, because they need cash to be burned out, they need a equity capital rather than a debt. Because debt, if they have taken, which most of the company do mistake, what will happen? They are burdened with the payments, interest payment, timely payments, repayments of the debt, and others. And there they fall. If they come out with the equity investment, again, it's a high cost. And but high cost doesn't mean that they will not survive. They will survive. If their business model is good, if their story is good, they are able to sell their story to the outside world. If they're able to do it, it's they have done their work, and valuation is skyrocketing of that companies. So I can give you so many companies which has been started in past. Like I've given you example of Jirodha. From the day one, they are very clear on the stock broking that they will charge the minimum 0.05 pesos on the transactions. So what happened on the volume they have gained from the startups which they have started is cash flow is coming in the business from the day one, and they have not used the traditional method of advertising. They use a unique method of advertising from the references from the one-to-one person, and because the technology is such that they are successful. So when we talk about the startups, they invest more in technology, they more growth focused, they more cash burnout in the first years. But cash burnout doesn't mean that they will not make profit in later part, or they are not receiving cash in future. It may be n number of period of time, or X number of period of time, they will start generating revenues, start generating profit. Because a company which is not able to generate cash in any time of time, no one is going to invest in that company. So we have to look at when the startups features are there. What type of features we look for valuations is one, whether they are destructive innovations, they change the way the people are used to, and whether they add value for the people life. If yes, there will be a good value of that company. Second point is whether they are first. So they are first starters in the industry. They were having a market share, number one, number two, because most of the time they reap the benefit of profit in number of situations. So they also keep investing, keep innovating in the business, and innovation is such they scale up to the mark where they can make profit. They stay ahead of their competitors, which might later make them profit. So these are the way when I look up at the startup for the valuation. Then third thing, the features which startup have while we do the valuation is they are high on the technology. They are high on the technology means means they invest more on the technological fund because they are the new. They are new, and we believe on that through technology they will make changes. They will bring changes in the common man life, and then their valuation is high. So what type of valuation related work a CA from CA you can expect? Two kinds of valuation work is when we talk about the opportunity for the chartered accountant to be as a SFA. valuer. So there are two type of work in the market. One is valuation certificate type, where they need to do regulatory compliance, and you have to issue a certificate as a valuer, registered valuer. Companies Act talks about so many places you need to have a valuer certificate. So this type of assignments are there. And another is properly valuation exercise kind of work is in the market. And where you think where the money will be, where do you exercise kind of valuation? Because there you bring something on the table for the outsider that see, according to me, this is the company is worth for. If you find that the value which I have assigned with the story which I have and the price which is currently prevailing in the market, or you getting the investment in the market, whether it's overvalued or undervalued. If it is undervalued, invest it. And when we do the valuation exercise, we always check. Even though we have to say that you cannot be having a financial interest while you do the valuation. That is for the past. For the future, if you believe that is undervalued through the valuation exercise, you should have a intent to invest in that business. Then only you will say that you have done the valuation exercise properly, because that is the stories backed with the number which you are talking about in the valuation exercise kind of work. Valuation certificate kind of work where we do the net book value or the intrinsic value where we generate, or the future cash flow which we discounted, and we have already discussed two way of doing the valuation, and then you issue a certificate under the URI. Now, valuation certificate, when you say it's a valuation certificate, value and transaction almost decided, need a formal endorsement for buttress of the valuation arrived at, no value added, relatively very well low value added, high in volume, because most of the time you have to issue the certificates, low hanging fruits, and reasonable level of expertise is sufficient. No very much big number crunching in that required. See, sometimes when you do a valuation exercise for a company, like what will the my market share in the company if I have a car company. So suppose Fiat is taking an exercise that what should be his their value. So at that time you have to crunch the numbers. So many numbers you have to look at. So many competitor numbers you have to look at, and then you have to find it out. SWOT analysis you have to do, and then you find it out what type of valuations you have received at. So in that valuation exercise, value you don't know what should be the value until unless you start working and you generate data. You have a studies because transaction has not been taken place, and you have a very vague idea about that what should be the value and what type, whether you are adding value. Yes, big time, because on your valuation report someone is going to invest in that company. Very far and few between, non-reckoning. Once you have done the valuation, it is not always you have to do. It may be once in a blue moon, it comes to you for doing a valuation exercise. Potentially high paying, high level of expertise, all these are required. So, how you can become a RV, we have already told eligibility, training, and exams. You can become a valuer. Like CA and with 3 year experience, you can become a valuer. Training requirement 50 hours of specific training, formal training with a specific to the each asset class. I have already discussed 3 asset class has been defined under IBC, and through you can through 17, it is not 16, 17 RVOs who do the formal training, and you can do the formal training And then you pass an examination for 2 hours examination online, which has been conducted. Fee of 1,500. Now it has been increased to 5,000, I think. And then you are gone through. So other requirements, you have to comply with the valuation standards. Now valuation standard 2020 is also out. Annual CP hours, you have to get it, continuous reporting, and you cannot be in employment, then you can become a registered valuer. There are so many registered valuers in the market. These are numbers, you can find it out from the IBWay website. And these are the data which we talk about. Now we talk about the valuation. Who is a regulator? IBWay is a regulator who have a authority and recognize RVO as well as RBs. They have a comprehensive responsibility for development and regulation of the profession. And methodology, we have so many methodology. We have discussed on the various methodology is like book value method, NAV, net worth, discounting cash flow method, PECV method, transaction multiples business, comparable multiple, hybrids, and many others. So why you, whether you need to have known to everything. Now it depends on what type of assignments you are taking, valuation certificate type of assignments or valuation exercise type of assignments. Then uh, now whether it's a meaningful sense of valuation exercise, yes, chances are you are already knowing so many things during your CA curriculum. Now you can become a very well chartered accountant as well as the valuation professional. Currently, you can do both the things at the same time, but going forward, the government have a thought that there should be a separate entity which will be govern all the SFA valuer, and you should be an exclusive profession of valuation, but it will take time. Now, DCF we have already discussed. Number of valuations, no, you can't do so many numbers in valuations because it takes a lot of time, lot of number crunching, as well as you should believe on the stories and you should stand by that stories. So, distress value, some situations also need valuations. So now now, this is a very, very good thing. Triggers for need for valuation work. As I, one of the topic for today is I have to discuss about the opportunities in valuation. So there are two type of opportunities for a valuer. If we talk about, one is regulatory, where Companies Act talks about that only registered valuer can do the valuation. These are changes, welcome changes for the valuer. There is another place where we regulatory requirement is income tax, as we have discussed. In income tax, only merchant banker or a chartered accountant can do the valuation. Under FEMA, only chartered accountant can do the valuations. And as we are a chartered accountants, we can do that. There is a insolvency and bankruptcy code. Yes, this is the one is my favorite topic, Insolvency and Bankruptcy Code 2016. Now, in under Insolvency and Bankruptcy Code, there are three stages for the company. One is CIRP, under which the company is gone for a corporate insolvency resolution process when any company is unable to pay debt and the threshold limit, which was from 10 lakhs to 1 crore, 1 lakh to 1 crore. Now the threshold limit is 1 crore rupees. If you are unable to pay on time, when the debt is become due, the creditors, whether it's a financial creditors or operational creditors, financial creditors means time value of money, where we have taken the money as a debt, then or any other operational debts means a debt which is arising due to the operations of the company, uh, whether it is for goods or services, then the operational creditors or financial creditors or the company themselves can take the company into the CIRP by applying to the NCLT, Honorable NCLT, National Company Law Tribunal, for under Section 7, 9, and 10 to declare themselves as a insolvent company. So now the first stage is CIRP. The second stage, if nothing is gone favorable, then it goes into the liquidation, and after that the company will get disposed of. So now in that also, in IBC, in CIRP also, in liquidation process also, it talks about that the asset of the company need to be get valued by the registered valuer. Now there the three asset class. One is land and building, one is plant and machinery, and one is securities and financial assets. Three different asset class. Minimum 2 valuers should be there. So 6 valuers will be required. And if there is a difference between the two valuer valuation is more than 25% now, earlier it was 10%, then you need to appoint a third valuer. And this average of the three will be taken as a value for that company to sell for. So in the CRP, when the valuation is arrived, the valuation will be kept as a benchmark for deciding the valuation applicant who want to buy the company. In the case of liquidation, to find it out what should be the value at which the liquidator will start auctioning is the fair liquidation value, which will fairly represent the value of the company or the value of the assets to talk about. Now, under these two things, there is a value requirement, and we know that these valuations are regulatory required valuations, which we as a expert you are providing a valuation, and on that valuation, a insolvency professional who either become a IRP, is interim registration professional, or liquidator, use that valuation report of a registered valuer. So this is also one of the requirement where the opportunity where someone can look at. Now, other than that, there is a place SEBI guidelines also say that for a valuation you need to have a registered valuer. Your valuation should be need to be done by a registered valuer. So these are the places where we need a valuation, and these are the regulatory requirements. So in these regulatory requirements, you issue a certificate, you have a work assignments, and then you issue a certificate, and on that certificate you submit it to the regulators. Now, for transaction also required a valuer. Valuation need to be getting done for the transactions, like when the venture capitalist or private equity are doing investment in any company or any stock, they need a valuer, that what is the value of the company or the equity, and on that basis they invest in the company. If it is undervalued or overvalued, they take a decision that whether they want to go for an investment or not. Again, over here, again I will repeat for just for a repetitions. Prices are different from the value. Value is something different, price is something different, and there is an equilibrium. Prices, if it is less than the value, it is undervalued, and you are investing in that company to make it up to the value. So At that time, the valuer need to work with the venture capitalist, with the company, and find it out what is should be the real value of the company. So these are the transaction type. Then again, in merger, acquisition, or demerger, you need to have a valuation report with you. In merger, when you are acquiring another company, when you are demerging your company, you need to have a valuation, get it done through the registered valuer. Then sell or purchase of business assets, business or assets. Also at that time, also you need to have a valuation, get it done. If you are coming for a joint venture, again at that time, either entering or either coming out from the joint venture, you need to have a valuer appointed. And then liquidation, which is already covered in the IVC also. So in that liquidation or the closing down of the business, you need to get a proper valuation done for distributing between the company owners or the partnership between the partners. So at that time, also for transaction, you need to have a valuation work get done. And believe me, there is a very good scope because we are sitting in the financial capital of the India, that these type of transactions, merger acquisition, investment, sale purchase, joint venture, all this type of business mostly happens in the metro cities. And we, as a chartered accountant, having a good exposure to the market, good exposure, good expertise, experience, we can do value add for the business in this field. This is totally a specialized field where we need to be a storyteller with back with the numbers. See, if we just taking 1 or 2 minutes time to keep it interactive or to keep it lively, the session, I will give you one example. See, as a chartered accountant, we are very much, pretty much well in number crunching. We know how to crunch the numbers, how to see the balance sheet, how to see the future cash flow, discounting, and number of years. If what we always feel, whatever big numbers we have, whatever n number of time, our Excel sheet is full with the numbers, then our value will be good. No, your number should be minimum. It will whatever sweet and small will be always better. Your simple numbers or simple stories will sell through much easier than your complex stories. So everyone will get connected. You will get more eyeballs than uh, person who criticize you later on. So the valuation is a work where I feel the chartered accountants should give more time to understand the business and add value to the businessman. Accounting and reporting also again in that field also that is our colleagues, and as a chartered accountant we always do. So in that also valuation work is required, like for testing of impairment. Now India is compulsory for listed companies. So now for testing of impairment, you need to get a fair value, which will be given by the registered value. Now goodwill calculations. If you sell the assets, now if we know that goodwill should be purchased goodwill, we can show it in books of accounts. So what should be the value of the goodwill? You need to have a valuer appointed. Purchase price allocation. So in that portfolio valuation also of private equity, venture capitalist fund, you need to have a valuer appointed. IFRS also again required at so many places that the valuation need to be get it done by the registered valuer. So these are the area where we do the valuation. And in the regulatory, there are two places: Companies Act 2013 and Insolvency and Bankruptcy Code.
There, the valuation need to be done only by the registered valuer. So, registered valuer is gaining momentum in these two fields because there are so many uh, requirement for valuation as far as regulatory is concerned. There are a lot of work in this field. SEBI is also saying that only RB can do the valuations. So now the three acts is talking about that income tax and FEMA time to come they will also fall in line, and the valuer have their plate full for the valuation exercise. This is a regulatory requirement, and as I told, which is high paying, not regulatory work, valuation exercise done for the business, transaction related. So there you need expertise, a specialized knowledge, and it's a very remunerative also. I will just give you example. Sometime back when the Ola valuation get done, the valuer's fees was skyrocketing. It's a 5 crore, 6 crore rupees for one valuation. You think about 5, 6 crore rupees as a chartered accountant as a fee, it is very difficult to get it. But for a valuer of that much exercise, and there are so many startups, so many companies which are coming up, so many PE funds, venture capitalists who need valuer day in, day out. And this place is not only occupied by the chartered accountant companies or ICWI, but other professionals also. As a management, as a MBA or BCom guys having a 5 year of experience, graduate with a 5 year of experience also can become a valuer. So now think about it, and who have an edge? As a chartered accountant, we have an edge because we understand the stories, we understand the numbers well than any others. But what happened? We are not looking at the story. We are not a very good storyteller or story listener. We always compare numbers. We always look at the numbers only. Whereas valuation is much more than the numbers. They are looking much more on the stories. If you have a story to tell to the world, your valuation will get up, not down. So you have to understand at what phase you are. You are as a startups, whether you are at a growth stage, whether you are at a mature stage, whether you are at declining stage. You can't behave like a 80 years old guy who can say that I also take risk like a 25 years old chartered accountant. They can't take. So they have to behave like a mature person. And if 25 years old guy who is in the practice want to behave like a 80 years old guy, then again something is missing. And when this is missing, it will not grow. So you are at what life cycle of your life, company is at what stage, you have to look at, and then you find it out the transactions, do the valuation, proper valuation you do, then you are sail through. Now, mistakes what we do when we are doing the valuation, instead of using weighted average cost of capital, we use someone, if the new valuer is taking the cost of equity, again wrong. You can't do that way. The assumption is sanity check. There should be some checks and balances. There should be some stories which you have put. Like if you are doing a valuation of Uber, I am just giving you an example of Uber. So what company you are looking at? Whether this company is a ride sharing, whether that is a taxi service, cab, whether they are in logistic company, what type of business they have. If you do as a cab service, their valuation will be X amount. If you do as a logistic company, logistic means they are started with the supplying goods also, supplying food also. So then their valuation will go up because the size is bigger. If you take only for a Mumbai ride, their valuation will be less. If you take it as a India ride or the whole world, they have their taxes, then their valuation will be more. If you feel scalability, if today they have a 1 lakh drivers associated with them, whether they can increase it to 2 lakhs in next couple of days, maybe you can say that 1 lakh drivers which they have attached to the Uber in 5 years. So next one another 1 lakh driver, how much time they will require? Maybe 1 week. So this is the scalability they can do it, and that's where the technology help them. Their pricing will go up, their valuation will go up. Same way, what type of services as a chartered accountant we are providing for? Do you think the valuation of India brand India, which Modi is selling since 2014, is the same which is valued earlier? Because we are not able to sell our stories that India is growing, and not only stories, you have to back it with the numbers. And that's why when we say about the UPI payments, when we say about the benefit, when we say about the Aadhaar linking, when we say about the other things, he sell the stories to the outside world that see we have growth numbers, we are the growing economy, and we are continuing to grow. And believe me, when this type of stories you are able to sell, your share market will go up from 25, 30,000 to 60,000, 70,000. And that is, and again, it is going up. And why? Because story is backed with the numbers. Sometime back, if someone asked me whether the Reliance valuation is over valued or Adani stock is undervalued, what do you think? That is my personal opinion, my valuation. I am not being paid for that valuation, so I will not give some numbers. But think about it, on what valuations they are talking about. I have a chance to interact with the Mr. Junjunwala, who always tell that India is growing, and you will see the India will cross the 60,000 the index in BSC. And at that time, people are asking, he is bullish on the Indian market. Yes, he was. He was bullish at that time. And the time we have seen much earlier than what he has thought for. So same way, when you do the transaction valuation, you have to have a story with you, which you sell through to the outsider, not to the insider, not listen your stories to the insider only, from the outsider also. Now, accounting reports, we have already discussed the testing of impairment, goodwill, purchase price allocation, portfolio valuations, IFRS, you need to have a valuation done. Now, statutory, under statutory, we have already discussed Companies Act, Insolvency and Bankruptcy Code. In these two, we, as a registered valuer, as a SFA, as a chartered accountant, we can become only one valuer for only one asset class, which is security and financial assets, SFA. We can't become a land and building and plant and machinery because they require a specific knowledge of engineering field. So, and believe me, there are a lot of work other than this Companies Act or Insolvency Bankruptcy Code. Companies are interested in taking chartered accountant services as a valuer for doing the valuation. In India, traditionally, we don't believe on the valuation need to be get done. We are more interested in the price rather than value. But it is gaining momentum as India, as our Prime Minister is saying, we always look at the value, what the others are looking at on our number. So income tax, FEMA, SEBI, India's, and as a chartered accountant, we are able to do it whether regulatory is provided earlier or not. But now, after the valuation rules are in place, the Companies Act and IBC code is done only by the registered valuer, not by the chartered accountant. Sometime back, someone have asked me if whether we can, as a chartered accountant, we can do the net asset value because we are signing the balance sheet. So net assets is what? Share capital and paid up capital. Paid up capital plus reserve and surplus is become a net value less the intangible and the other. So I told them, yes, as a chartered accountant, you can certify the net asset value. But as soon as you write as a valuation method is net asset value, then you need to have a valuation degree. So purpose, what is the purpose? Where you are using it is very important. For management purpose, you always give so many valuation certificates. So income tax and FEMA doesn't stop us. Even SEBI regulation now is making compulsory for a registered valuer. Most of the places they have changed it to the registered valuer. Earlier it used to be a accountant in practice. So India's IFRS. In Companies Act, so many sections like 62, which talk about the equity shares, sweat equity shares, issuing of shares on a preferential basis. You need to have a registered valuer. For section 67, for buyback of shares of own share by the employer or employees or a trustee. Section 192, non-cash transaction involving directors are also need to be get valued by the registered valuer. Declaration of solvency under section 305, report by company liquidator, administrator, or compromise or arrangement or merger acquisition. All these places you require a valuation by the registered valuer. Other than this, the acceptance of deposit rules, share capital and debentures rules, prospectus and allotment of securities. All these rules also you require a valuer. Issue of shares to the non-resident or share between the resident and non-resident or investment in a foreign company as per FEMA regulations, you require a valuation need to be done by the chartered accountant. In FMB, fair market value of the assets and liability of assets, securities, derivatives, goodwill, all these things, you require a registered valuer. In liabilities, OCD, compounding instrument, mandatory interest payment, bank guarantee, and settlement provisions, you require a registered valuer. In this, India's IFRS, we need a registered valuer. So, what does it take to be a successful valuer now? $1 million questions. What do you require to be a successful valuer? Common sense. That is, as we say, common sense is not common in all the person. Means common sense is required for understanding the stories which is told by the promoters, and you should have a Bunya Buddhi. Means as a chartered accountant, we know Bunya Buddhi. We have to numbers. If someone will tell tomorrow I will build 1,000 buildings in 1 month, you can understand it is not able to deliver whatever story he is making. So you should have a convincing power when you have bought in that how, suppose you believe that 100 flats he can deliver. So means you have convinced with the numbers, with the stories that yes, he can deliver 100 flats in 1 month. But how? You have to have a proper stories. Negotiation skills you should have. So negotiate with the different persons, and of course technical knowledge with discount to discounting cash flow and Kaizen. Kaizen is continuous reading. Read. You will understand more. And whatever you read, you find it out that there is some stories which is someone is building up for making their valuation up in future. But of course, not at all. There is a formal process that also you are required to get through for being a registered valuer. So valuation report we are not going to discuss because of precautionary of time, but it is available and you can see the valuation rules which talks about the how do you get a valuation, and ICI have given the valuation standards that what should be written in your report on your valuation report, and how what are the things which your report should also talk about. And with this, I'm through with my presentation. There are so many approaches. We don't have to look at all these things. These are already known to you. But my focus was to give you a brief flair of what valuation is all about, is what is the value and how you increase the value of yourself as well as for the business to whom you are appointed as a valuer, registered valuer. Thank you. Thanks a lot. Shruti, to you.
Thank you so much, sir. It was a great learning experience. Thank you for sharing such great insights with us. Sir, participants have shared few questions. I'll ask them one by one. So the first question is, can cash burn be in the form of cashbacks, discounts, referrals for a startup like Zomato?
Okay. What do you mean by cash burn? As I told you, for making a growth, making a startup companies which are doing cash burns for increasing their business uh, to make their customers to come back again and to stick with them. Uh, when you do the freebies or something to which they have not paid for, it's basically a crude way of seeing the things. But again, this is allowed. This is also you can do the cash burn. Pepsi, I know, understand the Pepsi when they came up in the startup of the company, when the Coca-Cola or Thumbs Up was taken in the market. So they have given the cash burn out in the form of a refrigerator or the fridge, which they have given to the each corner panwalas to keep their the cold drink to start with, and they were destroying the uh, bottles of thumbs up or the something. All these things happen. So cash burns you can do, but again, whether it will fetch your customer again or not is a big question. So you can do the cash burns, but again, it depends on the your investors who are pouring money on you to see the number of growth which is for your brand or for your company.
Thank you so much, sir. So there's one more question. Why regulators allowed companies like Amazon to sell a product below its cost?
Okay. Very good question, Shruti. This question is this is not the first time it is they are doing the to increase their revenue uh, at loss or at more than their cost, because uh, since 1980 when they have started the business, what their philosophy on this they believe it is uh, they will follow, means profit will follow them. If they have a numbers, if they increase the revenue, the profit will follow. And most of the time they have not made a profit in any business, but where they have made the profit, they have made profit on valuation. The market price of the shares of the Amazon is growing like anything, and believe me, they are destructive in the market. Means once they are in the business, so if they are coming into the retail business, on that same day when they announce that they will come into the Indian market in a retail segment, the share price of the other companies or competitor business who are in the retail business will fall down very significantly, and they will make a loss. And by the time their share price will get up, they are making loss like DMAT and DMart. we everyone heard about the Indian DMart company success. So you go in that store, you will find every product is on discount. Whether they will give a 1% discount or 10% discount doesn't matter, but everything is on discount. And whatever discount they are giving you, sometime that cost not cover the manufacturer cost also. So means manufacturer have given them manufacturer cost. Suppose I am giving you example of rupees 7, which they have MRP they have published it 10 rupees, and manufacturer cost is 7. The DMart has bought it at 750, but they will able to sell it at 6 rupees. So means they are burning 1.5 rupees. DMart is also burning 1.5 rupees, and that's why you are selling at 6 rupees, which manufacturer is manufacturing at 7 rupees, and buyer or the customer who are buying at 6 rupees feel happy. The 1 rupee discount which the DMart has given you, their share price will increase by 5 rupees by giving you 1 rupee discount. If you see how much DMart price is increasing in a day, I am giving you a rough idea. Whatever sale they have in a day and whatever discount they have given, their market price will be higher than that. So that is the story where they are making money, not only at the stores but at the share market also. And as Amazon, you have asked, so they will make a profit later on, someday, some point of time, but not today, because they are they are in the market with their army. What is the army? Amazon doesn't have an army, no? But they have an army of Amazon Prime membership. Billions members are already in Amazon Prime who are paying maybe $50 or $100 in a year. And what happens as a Rakesh, if I have taken the Amazon Prime, I have committed 500 rupees a year. I am paying to the Amazon. It means someday or sometime I will go through the Amazon Prime which they are want to show me, either in retail, either in their business, either in their Amazon Prime or XYZ 10 type of business they are in. 10, 8 items I like it, 2 items I don't like it, but I have to like them or I have to see them. And that is the army where they want to bring me, they can bring me. And we are very loyal to that Amazon as a Amazon Prime member. So these consumers will make a disruption in the market. And that is the story where they are playing in, and their valuation is going up. And this story is Amazon is stick with since last so many years, and in future also they will stick, and that's why they are making profit. They kill the competitors in the market by selling below the cost price. So if they, I know the prime which you are getting in 500 rupees is cost them minimum 5,000 rupees. Even then you are getting it at 500 rupees. And what is the story behind that? Why they are selling you it at 500 rupees? They make a army which is very loyal to them, and you will stick with them for next 10 years, 20 years, 30 years. And there they make a profit, not from this business, from other business. If you have gone to the retail trade or to any other trade or any other place, and sometimes also you will get a SMS or WhatsApp also, that okay, you get a, because data is a king, and that's why we are talking about the data privacy, and we are looking at the regulations to be in place to regulate the market, and we have a CCI and others in the place, because they are very smart, and they are not losing money because they have a story to tell you and how they are doing the business. It is I hope I have told you how the Amazon is business is doing it. Yeah.
There are more questions. There's this question that they hear the term dragons in this context. What is this term? What are these?
Okay, so when you say dragon is coming, we always see that China. We see dragon as China. What it means is basically when the Amazon is coming, they kill the other businesses because of they want a revenue share or the top line, basically a sales number. They want to be market leader in that. They don't want to be laggers in the business in that area. So wherever they go, they go with the big numbers, big bang, with the big market share, and that's why today or tomorrow they will make a profit, and that is the story which they are selling it since so many period of time. Yeah.
Thank you.
Next.
So there's one more question. How to stay updated on market trends and developments that may impact the valuation of securities and financial assets?
Okay. Now, again, as we have told, that market price is what? It is a price. It is not a value. So, valuer doesn't get paid for doing some price related mechanism or price related work. They are get paid for the valuation, which is need to be done based on the stories which the company have and backed with the numbers which they have to make it through the complex methodology. There are so many methodology, and they have to look at what type of method is applicable on that type of product. So when I'm using intrinsic value, when I'm using the relative value, whether this method will give you more accurate numbers or that will give you more accurate what we say stories than another number. So then you have to look at the valuation in that angle, not according to the price. And my observation is, when you are comparing price, you compare price with your value, and if it is undervalued or overvalued, you have to take decision accordingly when you have to come into the market or come out from the market.
Thank you so much, sir. It was a great learning experience. And as we conclude this session, on behalf of the Valuation Standard Board's ICAI and all the participants, I extend a sincere thanks to our distinguished speaker, CA Rakesh Kumar Tulsianji, for sharing great insights with us and sharing the intricacies of how to win others with their stories. We also express a gratitude to our chairman, CA Hansraj Chugh sir, and Vice Chairman, CA Preeti Paras ma'am, for initiating this platform for the field of valuation and guiding us. We would like to take a moment to acknowledge and appreciate our audience for dedicating your valuable time, even on a holiday. Your enthusiastic response has been a tremendous source of motivation for us to continue our journey of knowledge sharing. So thank you for your active participation, and we are eagerly anticipating meeting you again in our upcoming sessions. Until then, please stay informed and remain committed to your pursuit of excellence in the field of valuation. Have a wonderful day, sir. Have a wonderful day, everyone. Thank you so much.
Thank you.